Good evening and welcome. I'm Mamta Rawat from the corporate communications team of CareEdge. I welcome you to our discussion today on housing finance, sheltering instability and growth. We sincerely appreciate you taking your time to join us for this webinar. We would like to welcome our esteemed guest speakers for today. Mr. Mehernosh Tata, Managing Director and Chief Executive Officer at Godrej Housing Finance. Mr. Sudhakar Ekkirala, General Manager at State Bank of India. Mr. Suresh Iyer, Managing Director and Chief Executive Officer at Canfin Home Limited. Mr. Anurag Mittal, Head of Fixed Income at UTI Asset Management Company Limited. This session will be moderated by Mr. Sanjay Agarwal, Senior Director at CareEdge Ratings. We will commence the session with the presentation by Ms. Geeta Chainani, Associate Director at CareEdge Ratings. This will be followed by a panel discussion and a Q&A session. In case of queries, participants are requested to key in your panel. We will take up your queries at the end of the discussion. Now, may I invite Geeta to make the presentation.
Thank you, Mamta. Good evening, everyone, and thank you for joining us. In this webinar, we shall discuss the size and growth of the housing finance market and how this market has been growing in sync with the trends in the residential market. Post which, we shall look into the overall portfolio and financial trends of HFCs and our outlook on the sector. Firstly, coming to the housing loans market, size and growth. Individual housing loan portfolio for the industry, which is combination of banks and HFCs, stood at 33 trillion as of March 31, 24, reflecting a steady CAGR of 13% over the past 6 years. If we were to see this in the context of the total systemic credit, housing loans formed 14% of the total pie as of March 24. The growth continues to be driven by long-term and structural factors such as increasing affordability, rising urbanization, increasing nuclearization, premiumization in housing demand, and government initiatives such as Housing for All. Hence, over the next 5 years, we expect the segment to grow at a CAGR of 15 to 16%. Now, coming to the market share of HFCs. If we look at the player-wise bifurcation of housing loans, banks continue to dominate the housing loan market, facilitated by cost of funds advantage, reach, portfolio buyouts, and co-lending arrangements. Over the period of FY21 to FY24, the bank's housing loans have grown at a CAGR of 20%, while HFC's portfolio has declined by 6%. If we adjust this for the HDFC merger, the CAGR for banks seen during the period of 21 to 24 stands at 17%, while it is 12% for housing finance companies. The market share of HFCs within the housing loan market has been stable at roughly 19%, and this trend is expected to continue. The chart to the right shows housing loan disbursements. Interestingly, while the disbursements growth has been healthy, the growth rate has moderated from 35% in 22 to 12% in FY24. The moderation trend is in sync with the normalization in the post-pandemic demand surge for residential housing. Coming to the sales and launches data of residential properties, one can understand that the normalization of disbursements is reflective of this trend. As one of the key drivers of the housing finance industry, the residential properties market remains buoyant, with sales showing absolute growth of 74% since calendar year 19. While the sales performance in calendar year 24 reflects continued buyer confidence and market resilience, the year saw a slight decline in the sales compared to the previous year due to demand stabilization post-pandemic. This sustained demand for residential housing, both as a housing need and an investment option, augurs well for HFCs. As per chart to the right, The post-pandemic shift towards premiumization continues. The share of property launches with ticket size of upwards of 1.5 crore has risen to 30% in calendar year 24 compared to 11% in calendar year of 19. The share of launches having ticket size upwards of 80 lakhs increased to 58% of the total launches during calendar year 24 compared to 27% in calendar year of 19. Now, coming to the HFC portfolio mix and growth. The loan portfolios of HFCs grew by 13.2% to 9.6 trillion as of March 24, and this growth was in line with our growth projection of 12 to 14% for FY24. As we are aware, post-pandemic FY23 was the first full year of recovery, with retail loan growth rebounding and reversal in declining trend of developer finance portfolio. While growth continues to be led by retail loans, wholesale loans comprising project finance and lease rental discounting too witnessed growth during FY24. Due to this, if we look at the chart to the right, there has been a 100 basis rise in wholesale loans to 8% for March 24. While HFCs are cautiously growing in this segment, we expect the share of wholesale book to grow in the medium term, driven by healthy, though moderated residential sales and shrinking pool of stressed developer exposures for HFCs. We project a year-on-year growth of 12.7% and 13.5% for FY25 and 26 respectively. The downside risks to this growth are tighter liquidity, heightened competition, and conscious curtailment by HFCs in certain riskier pockets. If we look at the ticket size breakup of HFC's AUM, it reflects similar trends as shifts in the launches data seen earlier. For HFCs, we are seeing a gradual rise in the proportion of AUM having ticket sizes ranging between 30 to 50 lakhs, and decline in the proportion of AUM under 30 lakhs ticket size. What's noteworthy here is that the ticket sizes are not increasing at the same pace as residential property launches, indicating that the demand for higher ticket size loans is likely being met by banks and self-financing by investors. Now, coming to asset quality. The GNPA of HFCs as of March 24 continues to show an improving trend and stood at 2.2% as against a peak of 4.3% as of March 22. The improved asset quality trend is largely due to improvement in developer financing portfolio and stable retail GNPAs, which we will see in the next slide. So far, there are no imminent signs of asset quality issues with 2-year lag GNPA and pool of assets in stage 2 and stage 3, all showing improvement in FY24 and half year of 25. Coming to the segmental asset quality, the chart to the left shows wholesale versus NPAs versus retail. In fiscal year of 22, the GNPA for wholesale segment rose sharply to 20.5%, driven by slippages in bulky project loans, which impacted the overall asset quality of HFCs. Since then, the impacted HFCs have focused on recoveries, NPA sell downs, and write-offs in their stressed asset book, leading to an improvement in the wholesale GNPA. As we see in the chart to the right, the retail segment has also experienced significant improvement in asset quality, both during FY24 and half year 25. Additionally, the softer buckets DPD of HFCs show no signs of concerns. Now, let's look at the leverage and the resources mix. Similar to the NBFCs, HFCs too have witnessed deleveraging post-liquidity crisis and the pandemic shock. Post-pandemic, the sector attracted healthy equity pools due to secure nature of lending, low credit costs, and opportunities in the affordable housing. This, coupled with internal accruals, has buoyed the net worth and led to improving capital structure. Now, coming to the cost of funds. We see that the rise in cost of funds during FY24 is mainly on account of rate transmission via banking and capital markets. During FY23, the weighted average lending rate of scheduled commercial banks to the finance sector has increased to 166 basis, which was visible in cost of funds movement during 24. Further, while there has been a 25 basis cut in the repo rate during February 25, which would lower the cost of funds on HFC's repo-linked bank borrowings, the overall cost of funds for 25 is expected to remain in the similar range of half year on account of continuing tight liquidity conditions. Coming to the borrowing mix across different rating bands. Higher rated entities tend to have relatively more diversified sources of borrowing mix compared to lower rated peers, who tend to rely heavily on bank borrowings and NHB refinance. The RBI's decision in November 23 to increase the risk weights for bank credit exposure to NBFCs by 25 basis has prompted HFCs to explore alternative funding sources. This has resulted in an increased share of NCD borrowings within the mix, particularly across the higher rated HFCs. The declining share of public deposits that we see for AAA rated HFCs is primarily on account of conscious curtailment of high cost deposits by one large HFC. Now, let's look at the profitability metrics for the sector. HFC's NIMs in 24 improved to 3.7%, which is at par with pre-pandemic levels of FY19. The rebound in NIMs is primarily driven by increased credit demand, improvement in yield, as well as overall demand or overall decline in the gearing levels of the sector. HFCs have also started strengthening their presence in the affordable housing segment to protect the spreads, which is positively impacting the margins. As HFCs look to augment their branch network and expand into affordable housing segment, OPEX as a percentage of average total assets marginally increased to 1% in FY24. Stable asset quality metrics, sell downs, and recoveries-led provision write-backs have led to declining credit costs for HFCs. The significant decline in credit cost to 10 basis during half-year FY25 is on account of few large HFCs witnessing provision write-backs. Collectively, the rebound in margins, reduced credit costs, have resulted in return on assets of 2.2% for FY24, which is aligning with the pre-pandemic levels. Let's look at the CARE's rating distribution of HFCs, whereby 18% of the companies fall in AAA band, 43% in AA band, 20% in A band, with BBB and below having 19% of the companies. Coming to the outlook, CareEdge Ratings projects the housing loan market to grow at a CAGR of 15 to 16% over a period of 25 to 30. Within the HFC's portfolio mix, the wholesale segment is likely to witness cautious growth, with its share in the overall mix expected to rise to 10 to 12% in the medium term. With no imminent asset quality risks, GNPA is projected at in the range of 1.6 to 1.8% as of March 25 and 26, while credit costs are expected in the range of 40 basis in the medium term. On the profitability front, the return is expected to be in the range of 2.2 to 2.3 over the next 2 years. While the gearing levels of the sector has reduced on the back of fundraising and listing of a very large HFC during FY25, We expect the gearing levels to increase to 6.5 to 7 times range in the near to medium term, as companies which have recently raised equity will look to lever this. With this, we come to an end of our presentation, and may I request Mamta to take this forward. Thank you.
Thank you, Geeta. Attendees are requested to key in their question, which we will take up at the end of our panel discussion. Now, may I invite Mr. Sanjay to take over the session, please. Sanjay Agarwal is a senior director at CareEdge Ratings. He has over 28 years of experience in the field of ratings, banking, and infrastructure finance. Prior to joining CareEdge, Mr. Agarwal worked at ICICI Bank and IFCI. He has a bachelor's degree in commerce, a grad of CWA, and a fellow member of the ICAI. He is qualified as a financial risk manager from GARP USA and as a certified financial planner from FPSB India. Over to you, Sanjay.
Thank you, Mamta, and thank you, Geeta, for the presentation. You have brought in very pertinent points in the presentation, and I am sure we will have a very enriching discussion with our panelists. So let me introduce the panelists first. So we have Mr. Mehernosh Tata, who is the MD and CEO of Godrej Housing Finance. Mr. Mehernosh Tata is serving as the managing director and CEO of Godrej Housing Finance, which is a part of Godrej Capital. This is the financial services arm of Godrej Industries Group. He is a qualified chartered accountant with about 25 years of rich experience in financial services. His expertise spans over secured and unsecured lending, credit risk management, and commercial banking. Welcome, Mr. Tata, to our presentation. Our next speaker is Mr. Sudhakar Ekkirala, who is a general manager in State Bank of India. He is a seasoned and accomplished banker with over 35 years of rich experience in various facets of banking. His academic credentials include MBA in finance and is complemented by certification in various other domains of banking. Currently steering one of the largest branches of State Bank of India, which probably would be equal to the some of the banks on a whole basis. Welcome, Mr. Sudhakar, to our presentation and a webinar. The next speaker is Mr. Suresh Iyer. Mr. Suresh Srinivasan Iyer is the Managing Director and CEO of Canfin Home Limited. He is an MBA Finance with a graduation in BSc Statistics and has worked earlier in Group Finance since 1997. He went on to become the core management team early in his career. Having a steady work experience of over 25 years in Group Finance, he's worked across various multiple positions and locations of that company. Welcome, Mr. Iyer, to our webinar. Our next speaker is Mr. Anurag Mittal. He is the head of fixed income from UTI Asset Management Company. He is a chartered accountant and holds a master's degree in science from University of London. And he has held senior position in various other AMCs. So, welcome Anurag to our webinar. So now we start our session. My first question will be to Mr. Mehernosh Tata. In terms of the industry itself, the real estate is cyclical in nature, given the both sales and disbursements are normalizing. Where do you think we stand in the current upcycle of the housing finance market?
Yeah, thank you, Sanjay and Care, for having me here. Appreciate the opportunity to speak to you and your viewers. I think to your question, yes, real estate is cyclical in nature, and what we are observing is that maybe the exuberance and froth in the market now is coming down. After post-COVID, we did see a fairly strong demand on the housing side, people wanting to upgrade from 1 to 2 BHK, 2 to 3 BHK, and so on and so forth. And a lot of pent-up savings going into housing. But we are starting to sense that the market froth seems to be coming down a little bit more predictable. However, as we all know, and your data also showed, housing continues to be a very safe asset class, and there has been a shift from more budget homes to slightly more premium homes. We are seeing people across tier one and metro cities look at more of these premium homes. And it has got to also do with the fact that disposable income in the hands of individuals are increasing. uh, Very clearly, on the tier 2, tier 3, tier 4 side, the government has, and including the regulator, is working to help LIG and EWS profile customers also get home funding. Therefore, we have the PMAY2 scheme, which has been launched last year. The recent budget has also given a fillip to the salaried class, where, up to 12.5 lakhs salary that you're earning with the rebate, there'll absolutely be no tax. So there will be some income in the hands of these salaried persons to be able to look at, buying a property in the event that they're looking at buying a property. So we feel that the first time home buyers will come into the market more for in the budget segment as we go along in this calendar year. Also, a 25 bips rate cut and some more on the annual in this calendar year will make the headline rate of interest for housing to come down, and therefore create more interest in home buyers to look at it. Up to now, with the repo rate increase over the last 2 years, we have seen that housing loan rates have also steadily moved up. But I think from this calendar year, at least, we should expect the rates to come down, subject to no other geopolitical risk really going out. So, yeah, I think overall, I would say that fairly resilient market, and huge opportunity for all of us in the housing finance space to continue to support home buyers buying their homes. Thank you. You're on mute, Sanjay.
Yeah. My next question is to Mr. Sudhakar. Given that the prime housing finance companies are competing for the same set of customers that the banks do, so how do you assess the appetite of the banks for providing funding to the HFCs?
Yeah, good afternoon, all. Once again, I thank CareEdge for inviting me for the show, for this event, the webinar on housing finance, which is the most interesting topic to discuss with, especially being a state banker, where as all of you know, we are the leader in the market. And as you're going for your question on the assessment of the HFCs, so the ability of the HFCs is assessed. The assessment of the limits or the financial requirements basically linked with their corporate governance practices, the policies which they have internally, and the collection mechanism, their internal assessment of their end customers, their housing loan borrowers, their borrowers primarily. So all these are assessed basically to look at the strengths of a particular HFC to enter into a very financing arrangement or engagement with the company, with the HFCs. And we, of course, also look at we have the internal processes of rating a customer internally, and also we look at the external credit rating of the rating agencies like you. And overall, we look at the pedigree of the management and the promoter strength to take the housing finance activity within the company forward, even if there are some negative cycles in the industry, how they'll be able to be resilient, and how the internal CG practices are outlined, and that the board of the company also definitely will look at the strength of the board, and we, as part of the assessment, we frequently interact with the top level management, and we get to know their the views in the industry, how their practices, how they are going to, what is their view on the growth of the industry per se. These will help us also in assessing the company's you know uh, financing ability and the ability to raise funds in the market if required. And the cost of borrowings, and the as in the presentation also it was clearly mentioned that the cost of borrowing and the NIMs at what level the NIMs for the past 3-4 years are moving, and the profitability of the company. These are basically broadly any company, for that matter, not only HFC, any individual borrower or a corporate. We are into majorly into various other corporate financing as well. So we look at all these aspects to make an assessment, detailed assessment of a borrower.
Okay,
Hope I have
so,
answered your question.
yeah, our question also was that you probably are also funding a competitor because they are
Yeah,
funding the same set of customers. But I guess you're looking at it differently as another business opportunity and
yeah. I
to
think
get to this.
yeah.
Yeah,
May
yeah.
I? Yes. Here, I think the borrowers at HFC level and our borrower at the bank level are two different set of customers. In fact, we look at the high segment and no high income and salaried customers mostly, and the HFCs mostly they are into affordable segment. And if you look at the even the borrowing and the lending, the percentage or the proportion which you look at the banks and HFCs, we are into more into the premiumization and the high income group borrowers that we lend. Whereas the HFCs are into more into 25 lakhs to 15 lakhs to 55 lakhs ticket size borrowers they lend to. So that is basically the difference. They are in a way, we don't look at it as a competition. We look at it as a kind of a wholesale kind of a lending to housings, no individuals. So we lend them, and we in turn indirectly we help them to lend to the larger housing finance borrowers.
Okay, so HFCs form another outreach for you for
Yeah,
a
in a
segment which
it's
is like
another form.
right.
True.
Yeah, so my next question is to Mr. Suresh. So, as Mr. Sudhakar has said, you actually have to do a more difficult job and reaching into a slightly, let's say, a smaller segment of customers. But how do you see the growth rate for the HFC, NBFC, HFC industry, and what do you think would be the medium to near term challenges?
Yeah, good afternoon, Sanjay, and thank you. And thank you to CareEdge also for inviting me to this webinar. And uh, I welcome and look forward to this very interactive session. So your question about this, what is the role that the HFCs play and how they are, what is the growth that they are looking at? I would
No,
say
what is the growth they are looking at, and
correct.
what are the challenges in the near to
Correct.
medium term?
So the HFCs I would say would definitely would be looking at a higher growth. Some of the smaller HFCs are definitely you would know be growing at a much faster rate than the industry. That is because there have been some incentives which the government has been offering. So overall, the affordable housing segment should be growing because of a smaller base at somewhere in the range of about 20% is what I would assume. And for the medium size HFCs, it would be somewhere in the range of about 15%, which is the overall rate at which the industry is also growing. So this is where the growth rate for the housing finance companies would be. In terms of the challenges, I think the biggest challenge, of course, is going to be the resources. That is raising the on the liability side is going to be the biggest challenge, because on the asset side, of course, there is a good demand, as my co-panelists also already mentioned. There is a good amount of demand, and there is across the segments there's going to be there. But the challenge is going to be in terms of the resource raising. And the second challenge, which I believe is going to be in terms of the changing regulatory scenario, because in terms of the regulatory scenario, in fact, there has been a lot of the some of the earlier benefits that the housing finance companies were enjoying because of the regulatory arbitrage, that is somewhat kind of getting eliminated. So somewhere, the smaller HFCs would find it a little bit of a challenge to kind of cope up with the kind of regulatory changes that are coming around. In fact, in the last couple of years alone, if you see, there have been many changes which the regulator has introduced, which puts them on a kind of a equal footing with the banks and the larger players. Like, for example, the LCR requirement, like in terms of the coverage and the LTVs that they can give, and all those kind of things. So basically, even some of it in terms of the deposit raising, although there aren't many deposit raising HFCs and NBFCs, but basically the regulatory is going to be another challenge which is going to come about. So HFCs, and particularly the smaller ones, will have to ramp up their compliance, their risk, and all those aspects to be able to compete and be relevant and compete with the bigger players. So these are the major things I feel.
Okay. Yes, so I think the stage is set for Anurag now because Mr. Iyer has already said that resources is the biggest thing. And we've seen that AAA entities actually turning a lot to NCD market, and HSC has also taken some significant bit of primary equity, while the secondary equity has been much higher, but even a significant bit of primary equity has come in. But in terms of the overall size of the market and appetite of the market, how do you see the market position right now for financing housing finance companies?
Thanks, Sanjay, and good evening, everyone. And hope you find this session useful. And thanks for inviting us. So, on the question regarding how housing finance companies have been turning to capital markets, even if we exclude one significant entity, which went for a merger, the housing finance companies have grown at about I would say 18% CAGR in last 3 years in terms of issuances. Uh, I think the nature of the financing is changing because one of the interesting developments in the capital market is the rise of insurance companies and pension funds. So they are seeing significant amount of flows, whereas from mutual fund side, because of taxation changes, if you look at the assets under management on the fixed income side, they have been largely static for the last 3 to 4 years. So I think there is a lot of opportunity for highly rated housing finance companies, but probably from 5 year and above, tenor, where probably they would get more demand going ahead rather than the shorter term tenor, where traditionally the housing finance companies have been looking at. So I think that's something which on the ALM side, I think housing finance companies, can focus on and probably think towards raising more of long-term funding.
Okay, so you are saying that the housing finance companies will have to, I mean, they are getting a lot of support from the pension and the insurance market, and which actually is a very long-term market, so is also suitable to the industry.
Absolutely.
All right. I come back to Mr. Mehernosh. Given the increasing competition, it's becoming challenging for the HFCs to provide a suitable NIM. I think that is a perennial challenge. In your opinion, what would be a good mix or an optimal mix of the slightly high yield assets such as builder, LRD, LAP, affordable for a prime housing finance company, especially from the risk taking perspective?
Yeah, I think it's important to have a reasonable return on equity. That is a fair ask from the shareholders, and a mix of prime housing, which could be which takes care very strongly of your risk matrix, at the same time having a affordable housing foray as well is important. So you cater, as we all know, as HFCs, we have to manage the primary business criteria in terms of IHL, etc. So therefore, catering to the prime and the affordable housing segment will give you a balanced, a blended yield over there. Of course, as you said, a lap done smartly and done correctly with the segment can give you also a little bit of a bump up on yield. There are a few large housing finance companies which are doing wholesale lending with developers, but again, that is something which has to be done very mindfully, I would say, and only if one has a very strong team and expertise around that. Otherwise, we are better off doing more on the retail side rather than trying and doing something with developers or even very large ticket LRDs, right? So I think these are 3 or 4 things that one can do. Of course, you could also do personal loans, you could do gold loans, you could do some other products as well, as long as you're covering 65-70% of your AUM as housing. So each, I think a good prime housing company should look at a mix of prime, which drives the risk matrix, affordable, which sort of gives you the value and the uptick on yield, and some sort of a lab business, which gives you an advantage again to meet a set of self-employed customers, salaried or self-employed customers for reasons that they need the funding. We have also seen some of the mid-sized HFCs resorting to co-lending, which is something which the regulator has allowed. So, co-lending could also be a opportunity, not just from a liabilities diversification point of view, but also being able to give you a better return on your equity as you become a little bit more asset light on your model. So, some of these are ideas that are there for housing finance companies.
Okay, so getting slightly more granular on it. So in terms of principal business criteria, so do you think that the PCB should be met by prime, or that could be met by a mix of prime and affordable, and the rest of the assets could be used to bump up the
Yeah.
yield? What is your sense?
Yeah, exactly. That's what I meant. That for your primary business criteria, which is giving housing loans, by and large, if you are a prime player, by definition, 3 to 4 times the average ticket size is going to be your prime, 50 lakh, 60 lakh, 70 lakh customer, whereas an affordable customer will be closer towards 15 lakhs. Again, there's a big range, and we all understand that. But I would say on a factor of 4 to 5. So therefore, you will have prime housing driving the volume growth for you from a PBC point of view. Affordable, of course, takes a lot more time to grow, but it gives you good value. It gives you better yield. You have to do it smartly. So these two products could get you your primary business criteria, and especially if you're a multi product company like us, then yes, by definition, prime will get you a higher portion of your PBC criteria.
Okay. And yeah, same question to Anurag in a different manner. But as an investor, what is your comfort with respect to views with respect to LAP and affordable housing segment in a prime house? So what are you willing to tolerate, and how are things?
Sure. Thanks, Sanjay. So, see, you know, well, any highly growing affordable housing company, ultimately it remains exposed to one limited seasoning of the book, and by nature, it's vulnerable customer segment. Uh, I think affordable housing companies are yet to be tested in a period of a prolonged economic slowdown in which we are probably entering right now. Second, a lot of credit assessment and affordable housing is done at a local level, where the local fleet on street is typically assessing the borrower's income capability and cash flows. And whenever there is a competitive intensity, there could be some dilution in underwriting standards for some entities. Not saying for any particular, but generally for a sector, there could be some dilution for some entities. Thirdly, the borrowers, which are typically the affordable housing, or LAP customers, they're also accessing credit at through multiple channels, either through unsecured loans, personal loans, etc., etc., where they're also paying very high interest rates, and they're again exposing themselves to any weakness in the business. Secondly, many of the affordable housing companies that we are seeing right now, they started probably very strong in one region, and in the last 3 4 years, they have moved to pan India, I would say. So it remains to be tested for us as an investor, that how they're able to scale up and show that resilience over a period of economic cycle, I would say, on how they can manage this whole evolution from a regional player to probably a I think national player. So that's something as investors, we look at when we evaluate these entities.
Okay. So we've taken audience questions. So I directed to Mr. Suresh here. What do you think is the impact of risk-weight revision and interest rate cuts on the funding for HFCs?
You're talking about the risk weightage because of the interest rate cuts.
No, risk weight cut, that 125 to 100%.
Okay. So obviously that is going to benefit, because some of the smaller HFCs, because this in terms of the NBFC exposure, there were limits which were curtailed for some of the players because of this higher risk weightage, which obviously will help some of the smaller HFCs, because their availability of funds from the banking sector will slightly improve. So that definitely is something which will benefit them.
And currently, we see that, especially in the some of the unsecured personal loan and then MFIs and all that, and some of the unsecured business loan, we see some significant wave of asset quality risk being there. So, do you think that this risk could overlap your customers in the housing finance business, and could they be a source of concern at some point of time?
See, for the affordable housing segment, which is the some of the players which are operating in the ticket sizes up to 15 lakhs mainly, this definitely would be an issue because there could be some loans which would be there would be a overlap, and there would be customers who would have also taken from MFIs. There would be some small personal loans definitely would be there if not MFIs, because the over the period, if you see the the amount of funding that is possible to the customers has actually come down because of the LTV ratios, because of the instead of going for the market value, you are going based on the cost of funds. So basically cost of the property, and also actually the customers, at least for the finishing of the property and at least for meeting the margin component, definitely have been resorting to personal loans. So therefore, and if in the smaller ticket sizes, it could also be some small, MFI loans or some kind of for income generating assets. So in that segment, there could be a little bit of overlap, and there could be some impact because of the on the delinquencies. And I believe that it is at least in the SMA 0 and SMA 1 category, there has been a slight uptick for some of the affordable housing finance companies because of this.
Okay. And my question for Mr. Mehernosh, we see that OPEX is continued to rise. That's what we've seen, right? It's almost hit 1.2% in our presentation. Do you see any direction to that, any purpose? Because we also see HFCs, the prime HFCs going into affordable.
Yeah.
So do we see any direction in that? What is your views?
So I think it'll stabilize because there are a set of prime housing companies who are expanding rapidly, setting up branches and having a significant manpower cost for servicing those affordable branches. So we expect this to stabilize. The expectation is that this should revert back to the mean, which is under the 1% mark, as we saw it even in your presentation. This is more, I would say, currently playing out on account of going out and significantly increasing your sales and distribution and branch network, because as my co-panelists mentioned, it is a very physical touch and feel model. And given the local flavors and nuances, you really can't do it sitting centrally. So some part of the OPEX is going towards that. As business starts rolling in, because this is the upfront cost you're doing, as business starts rolling in and your AUM start increasing, we expect this to normalize back. So to my mind, I think this is just I think it'll revert back.
Okay. And a question to Mr. Suresh Iyer. So we've seen in the presentation that while the gearings have come down from 7.5 to almost 5.5 levels, NIMs continue to remain the same, especially if you look at in FY19 to FY24 at 3.7 times, right? Which actually probably mean that the industry has become more competitive. So do you expect it to stay that way? What is your sense?
Well, I agree that this is scenario will I feel continue because the NIMS is something which definitely is people have been monitoring that, and as earlier also mentioned, this is an important thing, and spread and NIMS will be able to do that, because over a period you would also see that the upgrades in terms of the rating has also been there for the housing finance companies, which has helped over a period in bringing the cost down. So that I think will be maintained. even though the gearing levels have been coming down, and gearing levels have also come down mainly because of the fundraising that has happened, and the IPOs for a couple of HFCs and for the fundraising. So that is the main reason why I think this has come down. But NIMs, I'm sure, will continue because the rating has also been upgraded, and even with the rates coming down, I think the HFCs tend to benefit when the rates are coming down, because there is a lag effect in terms of the passing of the transmission of the interest rates to the customers. So that would also help for the HFCs.
Okay. My question to Mr. Sudhakar is that what is the cost of funding advantage that the banks have over HFCs? I mean, could you, let's say, give a value to that in terms of any particular figure? How do you see it? I mean,
Yeah, definitely. We stand in a better position compared to HFCs in terms of the cost of borrowing or cost of funds as a whole. We have, of course, the CASA on one hand. We have about 40% of our 40 to 45% of our total deposit base as a low cost. That definitely adds to our low cost funding for the not only for home loans, for any kind of a segment of lending. That is one thing. And we also raise bonds. Of course, being a triple rated entity or any public sector bank, it is easier to raise bonds with at a very low cost, as low as 6 to 7%. So this is another way, and the accruals that we generate every quarter, that also helps us in getting the overall cost of funds getting lower and lower. And on the other side, the yield also, average yield on advances, particularly home loan segment, also is decently on a better footing rather, and resulting into a better NIM for the overall banks at about 3%, 3 to 3.2%, almost on par with the HFCs. HFCs could have been in a better position also, because they can definitely price their products based on their cost of borrowings. The NIMs could have been definitely better for the HFCs compared to banks. That's what is my view, slightly differently.
okay. And now so my question is to Anurag. So, at what level? So currently they're getting at 5.5, and our team was suggesting that it could probably go up to 6.9 to 7 times. But for prime housing, what is the comfortable level for you? And would you be comfortable at the gearing going up to those levels?
I think typically for us, at least at UTI, we prefer entities for prime HFCs about 6.5 times at most, I think. And for lower rated entities, probably somewhere between 4.5. That's the number we typically.
Okay.
Yeah.
That's a very definite figure. Yeah, thanks. So yeah, given that the mutual fund industry would like to have a limit on gearing, so my question is to Mr. Mehernosh Tata, that do you think that significant fundraising would then have to be through securitization? And again, is a question from the audience.
Sorry, what is the question? Could you kindly
So
repeat?
do you see a significant fund mobilization through the securitization route, DAPTC?
Right. So again, I think for AAA rated companies, it may not necessarily be a very large vector. Clearly, from a diversification of liabilities point of view, it is. And I would say for companies which are A and in that category, triple B plus, A plus. Yes, I think securitization, both DA and PTC play a very important role. And we are seeing that to some extent. If you look at the overall India securitization numbers, both the mortgage securitization numbers over the last 3-4 years have improved. Clearly there is opportunity there. I would also say that NHB is also working on a platform where they are looking at coming up with a securitization very similar to the lines of I would say Fannie and Freddie, which happened in US, but effectively being a market maker and ensuring that they bring a platform for the smaller housing finance companies who may want to securitize or do a DA of 20 crore, 40 crore, may not have a very large book, look to even warehouse that and then offload it to a larger player who would be keen to take these assets, because they may also, most of them will also be PSL assets. So I do believe that depending on how big and what your rating is, securitization plays a role. Extent of importance changes, but it's an important liability diversification strategy.
Yeah, we agree with that. It's a liability diverse because in our rating process also, we do consider gearing, including the securitized assets, because somewhere it's linked to your liability franchise. While it's not an asset risk that you carry, but a liability risk that you certainly carry.
Yes.
And in fact, let's say FY25 will be a very different year for securitization because a large private sector bank is securitizing its retail housing loan with other public sector banks. So
Correct.
this will be a very different year. But probably next year onwards, things would stabilize much more from here. Yeah, and the question is to Mr. Suresh here on LAP. So, do we see any price competition in the LAP itself, or that remains a slightly significantly good source of profitability pool?
See, in terms of the demand, definitely LAP has a very large demand, but in terms of the pricing, just like in the affordable segment, it has happened. Even in the LAP segment, actually, the differential in pricing has actually been coming down over the years. So, in fact, with the considering the kind of risk, because the NPA levels, as was also seen in your presentation, but considering the higher delinquency in the LAP book, the reward that is there may not going forward be as commensurate with the kind of risk that is being taken. Of course, still there is a good amount of meat in this particular lab portfolios for companies to look at it. But going forward with the kind of competitive scenario that is evolving for lab, I think going forward the differential pricing may not be good enough. So some call may have to be taken. Plus the fact that some of the players who have already taken a higher exposure in lab, and the PBC criteria might, this may also start kicking in. They may exit. That's a different issue. But otherwise, the competition in the segment is becoming really, really hot, and the differential pricing is not as much.
Okay.
I had a point on LAP here.
Yeah.
LAP is a segment where, as Mr. Suresh here also has put it correctly, it's a risky segment. Even today the borrowers feel that they are entitled for a portion of that LTV. Without even looking at the cash flows that are being generated out of the LAP. So there is definitely a mismatch resulting into delinquencies. So they always look at the some portion of the value of the property to be demanded as a loan, and without backed up by the cash flows. So that is one major risk which I look at in financing the lab. That with they are whether HFCs or any other NBFC, they or even banks for that matter, have to be very, very careful in choosing those kind of structures.
No,
Yeah, and I think, yeah, please go ahead.
Yeah, no, I was absolutely agree with that point, because LAP is being looked at as a asset-based funding, whereas the business is basically a cash flow-based funding model that people have to look at. Somehow there's this line is getting missed out, that it's becoming an asset-backed funding.
And there is also a regulatory overhang that the regulators may come to you asking where is the source of, where is the use of funding, and how have you monitored the end use. So that risk anyway remains for LAP as a asset class.
True.
Yeah. And again to Mr. Suresh here. So in terms of our presentation, we've seen that there's significant amount of premiumization. A bit of the premiumization, I believe, would also be due to the inflation. So from a 19 to today, at least 50-60% price increase would have been there any which ways. But having said that, even then the premiumization is very strong. So do you see that trend being there and HFC being competitive in that scenario?
See, in terms of, first of all, there are two parts to your question. First is whether premiumization is here to stay. I believe yes, But again, premiumization is becoming again divided into premiumization, premium and super premium. So probably the super premium may not have, there would be obviously some limit to the super premium that is possible, but premium, of course, definitely today, the cost of construction is going up. The cost of, the land definitely has been going up considerably. So definitely the value of the property has been going up. So today, what was the norm earlier, as affordable housing companies would do somewhere around 10 lakh average ticket size. Today that has become 15 lakh. Same way for a mid-size company also, 25 lakh has to go up to about 30, 35 and so on for everybody. So even for a large players and large banks, that ticket size would go up to more like 75 lakhs average rather than this thing. So that is definitely going to be there. As far as HFCs are concerned, obviously, competing in terms of the premium segment is definitely very, very price sensitive. And therefore, being able to offer that kind of a competitive price would not be, feasible on a very large scale for HFCs. So there would be some limitation as to how much of that pie the HFCs will be able to take. They can definitely so a mid-size, the mid segment or or a slightly lower hang of the premium segment is where the HFCs will still be able to operate, but otherwise it will be purely for the larger players to operate.
Okay, so larger players mean largely banks and some of the limited number of large HFCs.
True.
There's an audience question for Anurag Mittal. So in terms of the asset classes, let's say housing, vehicle, MSME, lab, which one is more attractive, and is there any, let's say, limit to the attractiveness of each of those?
Well, thanks for the question. See, when we are considering any investment, I think typically it's a function of what is the kind of mix that any entity has. So an entity could be very geared towards affordable, or it could be a mix of LAP and affordable plus some SME. I think what matters and what when we look at what really makes an entity attractive is, one, the pricing for the right kind of risk that we are taking, the promoter pedigree, and the kind of capital support which we can expect, the kind of liquidity that the particular entity would have in the market. So it's a function of all these factors that's there. So I think so it will be difficult to say that XYZ sector is more attractive than others. It's usually entities that we invest in capital markets are well diversified. So I think so it's always a risk reward that we try to assess.
Okay, so I have some directed questions for Mr. Sudhakar, but they are just too personal because they're seeking some personal comments on how SBI does the lending. So we'll refrain from those questions. And a question to Mr. Mehernosh Tata. Competition from banks in prime lending space, since their loans are tied to EBLR, so which will see a faster transmission and that's the discussion we had earlier in this session also. So do you think this will give a competitive edge to the banks compared to the HFCs?
I would say there's always going to be a advantage for banks over HFCs, given that they have CASA. We just heard Mr. Sudhakar talk about the CASA ratio and things like that. So very clearly, there is no comparison from a cost of funds advantage of large banks, both private and public, vis-a-vis housing finance companies. The thing probably that can work to the advantage of HFCs will be how quickly can they turn around the request of the home buyer for when he comes to you for a loan, housing loan. What sort of digital or what sort of automation processes one follows to make the process more seamless. Third, but not the least, what level of customer service are you providing, and is that becoming one of your key differentiators, so that you can command a little bit of a premium over the pricing that the customer may end up getting from a bank. So, and fourth could be that it may just be that you may be selecting a segment which may not necessarily be very appealing to a bank. So the way we would look at this is to say that everybody is doing business. Your sheet also showed that almost 19% to 20% of the business is done, or the AUMs are there for HFC. So there's space for everybody to grow, and most certainly the banks continue to have the advantage of very low cost of funds. But at the same time, the housing finance companies have evolved to be able to give some other, I would say, benefits to the customer, on account of which the customer tends to also choose some HFCs over banks, despite the price points being higher. So I think there's enough food on the table for all.
Okay. No, I think the question was more directed at the EBLR providing some sort of a difference in the competition.
No, I think BLR, I mean, we are all aligned to it. So, I mean, we've seen the State Bank, reduce the external benchmark rates in line with the repo rate. Some of the other public sector banks have also done that. We are aware that a couple of private sector banks have also done that. So, I don't see that to be a very big differentiator. If you have to be in the market, you will stay in the range to be competitive. That's all I would say from most of the prime HFC's point of view.
Yeah, and they had increased the MCLR actually just a few days before that.
Correct.
Right. And my question is to Mr. Suresh Iyer. So, in terms of the HFC lending, it's actually across a yield spectrum rather than a narrow range. So then how do you manage the OpEx and the credit costs? So is it like segment by segment, or you see it on an overall basis? How do you manage that?
As you rightly said, there's a huge spectrum in terms of the customer segmentation that is there. And like this, the operating model for a housing finance company in the affordable segment will be completely different from an operating model which is used by somebody who's in the higher end of the market. So therefore, that is basically the item which determines the OpEx for all of them. Some of the affordable housing finance companies obviously have to have more feet on street, have to have a more detailed and process for analysis and evaluation of the customer in terms of their ability to pay and willingness to pay and all. And therefore, the cost would be higher. Plus, considering that again, the delinquencies also in that segment and the vagaries of and stability of income is also different. The feet on the recovery tool also, and the recovery mechanisms are also there. So the OpEx would obviously be higher for some of the, and as you go up the ladder in terms of the ticket size and in terms of the customer segment, more from SENP to salaried, the evaluation process is simpler. The repayment modes are more stable. The NACH is more functional. So all those things put together, the OpEx therefore will come down. And if you have a very good, presence, wider geographical presence across bigger markets, obviously that's a different, if you're dealing more with the developers and have a more APF-led model, that the operating model is different. So basically that is what will determine, and companies will have to accordingly price also, so that they ensure that they take into consideration all those things to maintain profitability.
So the question was again, that's a good answer, but the question was again from a single HFC that itself will operate in a pretty large, let's say, band compared to where the banks operate in a pretty narrow band of the customer choices. The HFC generally operate in a slightly larger band of the customer yield choices for the customers. So then how do you look at those, the overall profitability or the credit cost?
Well, you have to have a benchmark of what is the kind of NIMs, overall NIMs, and accordingly you'll have to work out as to how much is the segment that you would want to, how much is the allocation you would want to do for the prime segment, how much you would want to do to the affordable segment. Because I understand from where you're coming that there are some HFCs who are operating across all the three segments of affordable, mid-size, and prime segment also. So there will obviously have to be a overall, net NIM on the overall book that you would want to maintain, and accordingly you'll have to, kind of put factor into the risk model as to how much you want to allocate for your prime, how much you would like to allocate for your affordable. So that is the main challenge that you will have to work out.
Okay. And with this cut in the repo rate, do we see customers transferring to other banks or something for a lower yield, or that will remain the way our industry normally positioned? So,
See, in terms of the pressure, BT out pressure, so far, I don't think it is too early for the BT out pressure to actually pan out. And so far, for new customers, not many, cuts have come about. Although for the existing customers who are already on EBLR, the rate of interest benefit has been passed on by the banks. But in terms of the new customers who are getting onboarded, so the BT out pressure will come when, the new loans which are being given by other lenders are also at a lower rate of interest. So even if you may have reduced your EBLR, but if the differential or the spread over the EBLR has been slightly adjusted, then effectively you may not get the rate advantage that you're looking at. So far I don't think the pressure has really come about in terms of the BT out pressure or the loan transfers.
okay. Yeah, Mr. Sudhakar, any thoughts on this? Any views you would have?
On the repo rate cut, right?
Yeah, on the BT out and the repo rate, and because of the
Yeah,
repo rate.
yeah. I definitely the transmission of the rate cut will happen over a period of time, and not only that, the recent measures taken by the Reserve Bank of India to pump in liquidity into the system, like CRR cut during the last monetary policy review, and also the VRRR options. All these measures definitely have infused a lot of money into the system. That will augur well definitely for the HFCs and NBFCs overall, particularly HFCs, I would say. And this will definitely soften the rates of interest over a period of time, and we are on a growth path. I would say the next 2 3 years is going to be a very good for the uh, NBFCs as a whole and HFCs in particular.
Mr. Mehernosh, Tata, the State Bank is saying that probably the cost for funds would go down significantly given that a large amount of liquidity has been pumped in by RBI. So do you see the BT in from other HFCs being strong for the prime housing segment? How do you see the market developing?
Um, Definitely, I think we should expect to see a reduction in our cost of funds as well. I'm not too sure whether we'll see a very large BT in. Again, it is a different strategy depending on how one wants to follow. We are more led with APFs, so we sort of work with developers very closely and indirectly fund the home buyer. And therefore, for us, that is of more importance, ensuring that there are launches which are happening on time, etc. So disturbances around those areas could delay launches, which could in turn delay the funding of loans to the home buyer. So in my mind, at least for us, I don't see that as a big challenge. But yes, as rates come down and as Mr. Iyer also mentioned, as we start seeing the onboarding rates going down, then there will be a little bit of a scramble before market settles. But we can expect this year to be a little bit of a it'll go to and fro in the calendar year as we see repo rates changing. We expect 2 to 3 rate cuts in this FY 26-27 financial year, FY 26 rather. And if that does play out, you will see some people being more aggressive to offer very fine rate of interest to acquire. At the same time, for HFCs, there is a limit to which you could bring down your rate of interest. You really have to also manage your margins. You have to manage your return on assets, and therefore, to that extent, you will also be constrained. And really not try and do something which is to just gain market share, lose out significantly on your margins. So it'll be a balancing act, and different players, depending on the strategy that they are following and the life journey that each of these organizations is, will play their cards a little differently.
This was my final question to the panelist, to Anurag. So Mr. Tata has already said that it will be an interesting year and yo-yos will happen, probably reducing cost of funds, etc. But as the manager, our presentation, we said that the credit cost for the first half is 10 basis point. But we also said that it probably normalize at 30 basis points. So what is your benchmark? Are you looking at a 10? Are you okay with 30? Are you okay slightly more than that? What is the benchmark for a prime housing company?
In the balance sheet of most of the prime housing companies is very, very robust right now. So with the assumptions that you presented, I don't think that's really an issue with most of the bond investors. I mean, even with this base case or even slightly more, I would say, I would say bond investors should be more or less happy with these kind of scenarios.
Yeah. So right, yeah. So we have some rates going down, some money coming in. So I think we are in a good shape right now. With this, I would like to conclude our session. We have some directed questions from the audience, and we would not like to take them because the panelists here have spoken as general, let's say, experts in the market rather than providing an overall the view of their specific companies, and that is how we'll take this session. So we thank you all very much, and I transfer the proceedings back to our tech team. Mamta, can you take over, please?
Thank you, Sanjay, for moderating the session, and Geeta for your presentation. Once again, thanking all our guest speakers for their insightful views. It was a privilege to host you. And lastly, thank you to all the participants for taking the time out and being a part of this CareEdge webinar. For any further queries, feedback, or suggestions, please write to us in the feedback mail. Goodbye for now. Requesting the tech team to kindly log off.